Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to talk a little bit about the 60-40 portfolio that's been very popular over the last 40-50 years or so, but now the 60-20-20 portfolio is making all the news headlines. So we're going to get right into that, what it all is and whether or not you should be investing in the 60-20-20 portfolio. Okay, so a quick recap on the traditional 60-40 portfolio. The 60 and the 60-40 is really the percentage that you should have in stocks, whether that be individual stocks, mutual funds investing in stocks, ETFs, or index funds. 60% of the portfolio would go into stocks, and that would be a way to capture growth from the stock market over the long term. The 40 is, of course, 40% in fixed income or bonds. And the idea there traditionally has been that bonds will move in the opposite direction to stocks, so you're diversified your portfolio. Stocks go down, bonds hold their value or actually go up, so you're nicely diversified and can shelter, away from any storms that might hit the stock market, and the volatility of the stock market would be compensated for in the stability of bonds and being in a 40% bond allocation. It has been very popular over the last kind of 40-50 years or so, and depending on when you pick your time frames, it's returned anywhere from around 7.9% to 9% per year. And of course, traditionally, the best thing about it has been when the stock market has held off, it has held steady or maybe even has grown. But that has been changing over the last few years. There's been a lot of talk about the 60-40 portfolio now actually being dead, and I'm going to get into the reasons for that. Okay, so one of the main reasons it's come up that the 60-40 portfolio could now be dead is in the year 2022, this protection being 40% in fixed income just didn't work at all. In fact, when the stock market came down because interest rates were coming up, when interest rates go up, bond prices go down. So the diversification that you invest in when you do the 60-40 portfolio just didn't help you in 2022, and the entire portfolio was down that year. So the diversification just didn't provide you the stability that fixed income should do, and this was one of the reasons that a lot of people have kind of gone off of it. So longevity is another reason why the 60-40 portfolio is coming to be a little bit less popular. With people starting to live longer than we have before, there's a feeling out there that you need to have more invested into stocks rather than the 40% that you have into bonds. So it should be a higher allocation to stocks to prevent you from running out of money. Of course, something you need to think about is sequence of returns risk. If you happen to be getting closer to your retirement and the stock market has had a major sell-off, then this could really impact the money that you have in your pension or your investment pot, for example, and being able to provide for you for perhaps a 30 or even 40-year retirement plan. So this is another thing that's got people concerned. But there's another main reason why the 60-40 is not as popular, and it really comes down to things like geopolitical risk, inflation, high government spending, and high debt levels, and the feeling that all of that is not sustainable, and you're better off not having an allocation of 40% into fixed income. See, typically speaking, when we talk to 60-40, we're not talking about short duration like Treasury bills, things maturing in under a year, or even stuff that's going to mature in say 1 to 3 years. It's typically been more medium to longer term bond investment, like 5 years plus. And of course, with inflation, government spending, debts and deficits at all-time high, then the feeling is that it's just too risky, and you will not be compensated for the inflation risk that could hit your bond portfolio if you're invested 40% of your portfolio into it. So that has led others to come out recently, like Mike Wilson from Morgan Stanley, who's come out and presented an alternative, the 60-20-20 portfolio. So what's the 60-20-20 portfolio? Well, the 60% is still in equities as it has been previously, index funds, mutual funds, individual stocks, whatever. 20% remains in fixed income, but instead of having 40%, you're now going to take 20% of that fixed income allocation and allocate that to gold. And the idea here is gold is a great place to hide out with all of this geopolitical, high deficits, high debts, inflation. Then this could be a place to be, or should be a place to be, to have a percentage of your portfolio, like 20%, to protect from the hard times that could come as a result of inflation, government spending, and all of these sorts of things. So take a look at this quote from Mike Wilson where he kind of breaks it down in further detail. So he goes on to say, gold is now the anti-fragile asset to own rather than treasuries. High quality equities and gold are the best hedges. So the idea here is, of course, with inflation, for example, then equities tend to perform well because they can price in these price increases like we seem to be seeing at the moment. And gold, of course, has traditionally been an inflation hedge and also a place to go to if there's some sort of event, debt crisis, things like that, that we may see on the back of all this government spending and unsustainable debt levels that some people would say. We're actually seeing the central banks around the world increase their gold reserves as well, especially compared to US Treasuries. And for the first time since 1996, central banks around the world are holding more of the reserves in gold than they are in US government bonds known as Treasuries. This, of course, is a bullish indicator for gold. And we've certainly seen year to date an unbelievable run in the gold price that has just been crazy. But it's not just Mike Wilson of Morgan Stanley who's saying this. There's some really well-known and successful hedge fund managers over the last 20, 30, 40 years who've come out recently with quotes about advising that people should increase the gold allocation to their portfolio. Ray Dalio, for example, suggests gold as a shield for US markets at the risk of a heart attack. And by heart attack, he was really just referring to a debt crisis of some sort based on the amount of US government debt. A well-diversified portfolio would have somewhere between 10 and 15% in gold, according to Dalio. Stanley Druckenmiller as well, who's very highly regarded in the investment industry, said something very similar, where he's described gold as an attractive asset during times of currency or debt stress. So this is definitely something to consider for your portfolio if you're worried about things like inflation, a debt crisis of some sort, and of course geopolitical risk. And no doubt this is part of the reason why gold has moved up so much year to date. But of course, there's a downside to investing in gold as well. And Warren Buffett and Jack Bogle, for example, have never touched it. And the reason is it's not like a business. It doesn't produce earnings. It doesn't produce yield like, say, a bond would, or even if you're renting out some real estate, for example, where you know you're going to get a rental income. It's purely based on the price movements. You're going to buy now with a view of selling it at a higher price later because somebody's going to be willing to pay that higher price down the road. So just bear that in mind. But if you do want to add some gold to your portfolio, maybe up to 20%, then how would you do it as an investor, particularly here in the UK? Well, the easiest way to do this really is through exchange traded funds, or ETCs, exchange traded commodities. If you have a look in the screen right now, you can see a breakdown. I use Just ETF, great website for doing research on ETFs, and I've just sorted this by the fund size, so the amount of assets in each fund. And as you can see, iShares Physical Gold ETC is the one with the most assets in there, and then Invesco Physical Gold and Amundi Physical Gold as well. But have a look at that Just ETF where you can get more information on gold ETFs if you want to add it to your portfolio. Okay, so just to recap, the 60-40 portfolio has kind of been the standard for many, many years now. But some of the macro realities like government debt, central bank purchasing of gold, for example, inflation and geopolitical risk are changing that narrative a little bit now to get people to think a little less about 60-40 and a little bit more of 60-20-20 to include some gold. But remember, this is not a one-size-fits-all sort of rule. You need to think about where you're at in your investment journey and how far out you have to before you start drawing down in this money. Personally speaking, I think if you're under the age of 45, I think you should be at least 90% in equities, maybe 100, because you have so much time to make up for any losses that may incur with the stock market. In fact, a big crash in the stock market would be your friend because it gives you a chance to buy more at a lower level, knowing you don't need the money, perhaps to your 55, 60, 65, or even 67, for example. So I don't think you should be looking at this so much. You could maybe think about having a 5 to 10% allocation to it, but that would be the most in my idea. And of course, it's very speculative because it's purely based on price. If you're at or near retirement, or you're gonna need to access your pension or your ISA account to draw down in the next kind of 5 to 10 years, then it's something you may want to think about as a little bit of protection against inflation as well. So that's my video on the new 60-20-20 portfolio. Let me know what you think. Leave me a comment. Are you somebody that would be looking to add some more gold, get up to a 60-20-20 allocation? Are you 90-10, 100-0? What sort of allocation do you like to do? If you like the video, please click on that like button. I would really appreciate that. And subscribe to my channel if you haven't done so already. And as always, I wish you nothing but the best in your savings and investment journey.